Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Treasuries rally after private sector data signals a cooling US labour market, spurring traders to boost bets on a Fed rate cut. German chip maker Infineon joins AMD in its optimistic outlook for the sector, with AI driving sentiment. Plus, the International Energy Agency sketches two scenarios for oil demand, including one where oil consumption continues to rise out to 2050. The agency says a lot depends on EV adoption rates.
In the meantime, a quick check on these markets. Futures pointing higher. This is interesting. You're seeing Eurostoxx 50 futures higher by 0.4%. The S&P higher as well by 0.3%. Is that a shutdown story? Are we seeing that much volume? Are we just catching up to the trade that we're seeing in the bond market? Given yesterday, we were closed 10-year at 408, euro dollar at 115. Lots of cross currents this morning. The countdown to the opening trade starts right now.
Wednesday morning, good morning. Is the day finally here that the US shutdown ends? And if so, what are the implications for the bond market, for the equity market? What is going to happen next in terms of the narrative on the politics coming out of the United States? Will it affect the Fed? There's a lot to think about today, and it could be all change day in terms of the narrative. We get a series of data coming out over the next few days that could upend current market pricing. Maybe I'm overestimating what is about to happen, but it feels like it could be a pivotal moment.
Yeah, it could be a pivotal moment. If we get an end to the shutdown today, the longest shutdown in US history, that would be a pivotal moment. We'll see whether it was better to sort of travel than arrive and all of those, usual market cliches. It's quite difficult to get a clear picture of exactly what is the narrative driving equity markets, bond markets right now. We saw a bit of the impact of the data in yesterday's session, certainly on Treasuries. We saw Treasuries rising on the back of the softer data around ADP, so the labour market. And you could say that maybe the end of the shutdown is something that is pushing US futures higher this morning, but it's a little messy out there. Expectations are certainly building that we are a little closer to a Fed rate cut, and it would be possible to link that to both a drop in yields and higher stocks, of course.
Closer to a Fed rate cut maybe for the markets, but then you look out at some of the commentary you've heard from Fed governors, and maybe it's not such a sure thing. You flagged the story this morning, but we heard from the Cleveland Fed President Beth Hammack earlier this week as though they're starting to talk more about inflation than labor.
You read the Nick Timmer's piece this morning. Front page, Wall Street Journal,
the
right
Fed
up
whisperer.
There at the top, the Fed whisperer, Greg Ip, and him basically, if you want to listen to what's going on, these are the people you want to listen to. And they're basically saying the Fed is super divided, and it is uncertain whether the data that could be delivered post-shutdown will deal with that division, and as a result of which it is a coin toss as to whether or not we see a rate cut come December. The market's pricing a little bit more than that. Is the market over its skis in terms of that estimate?
Yeah, we're all a little in the dark, aren't we, without the full complement of data. And actually, we may never get some of it, as we mentioned yesterday. Some of that data may never come our way, may never be used by the Fed to evaluate where it goes from here. One of our guests coming up later in the programme doesn't see much room for rate cuts because of this focus on inflation. Mark
Dowding. Looking forward to him.
Of many other views. The key piece that no one seems to be talking about enough, and this is very in the weeds, Washington politics, is these healthcare costs. Because now you do have at least the expectation that the Democrats are going to come to the table. They're going to basically say, okay, we'll give up on these really ACA credit kind of things. Come 2026, January 1st, 2026, your healthcare costs in the states, if you're an American citizen, go up because you're not getting extended. This has been the key piece of the Democratic view. This is something that is going to show up in the data, maybe not immediately, but come spring of 2026, this is a CPI component.
We are in the run now to the midterms, and it feels like this is what everything is now about. Clearly, the Trump administration is concerned after the recent losses. Kind of how is it going to reorientate? What's going to happen on the cost front? I think is going to be absolutely key. Let's talk about the chip sector and talk about what is happening there. So, AMD predicts accelerating growth on data center demand. So does Infineon. Its numbers are out this morning. I've just spoken to the company, and that's the top line coming out of that business. They are seeing a huge pickup in demand when it comes to the data center build-out. Hon Hai is also seeing a pickup as well. The chips are definitely seeing the story evolving and getting much more positive. Now, Hon Hai's got problems in the smartphone market. Infineon's got issues when it comes to the auto sector. And broadly, it's talking about moderate growth. But the AI story is absolutely massive. And this takes us back to yesterday's session and the jitters around what happened with Nvidia and SoftBank selling. And it's just a huge uncertainty around this space at the moment. And this story as well about depreciation. And again, just a lack of clarity as to what is happening, but some really big moves around it.
I was really interested to see the extent of the drop in SoftBank, the share price down really substantially in Tokyo today on the back of its decision to sell its stake in Nvidia. You might have thought it put more pressure on Nvidia. Any ordinary stock at any ordinary time, that might have been the narrative, but that was not.
More for everybody else to buy.
Yes, exactly, dropped, but not by as much as SoftBank has dropped today. Infineon is really an interesting story because this really illustrates the way that the global economy is being reshaped and the supply chains are being reshaped by what we're seeing from AI. So this used to be a business. We used to talk to them about the car industry, about German industrials. We don't talk to them about that so much anymore. It's all about data centers and how much that's going to change the world.
And that's where I think today's trade is going to be so interesting because on the one hand, they use the AI buzzword. So on the one hand, maybe you will see the stock skyrocket in price. But on the other hand, every single company out there that's talking about AI demand and data center investment is being viewed with a much more critical lens about whether or not they can actually deliver on some of those promises. So I'm interested to see if this actually opens positively or negatively.
I would have thought they've upgraded their guidance around AI for 2026 from 1 to 1.5 billion. They're talking about the end of the decade. And remember, we're going to the second half of the decade. They're talking about 8 to 12. So it is a huge move in terms of the magnitude of their business that they're going to see. They are big, and 8 to 12 is a pretty big range as well in terms of what they're talking about. But in some ways, they're in the kind of the picks and shovels side of the story as well, which is where a lot of people are positioning right now. But this whole depreciation story around kind of what happens in data centers, how quickly do you burn out an Nvidia chip? Is it 2 years? Is it 4 years? Is it 6 years? Huge impact. Because at the moment, the debt funding story, and we'll talk to Mark about this as well, is becoming the story as well. And these data centers are going to be funded by debt. There's going to be a lot of kind of amortization issues that are going to have to be factored in. How fast can you depreciate these chips is the big question. And nobody knows at this point. So, as you say, all of these things, there's guesses, huge guesses going on in terms of what we're going to see by the end of the decade.
Right. Takes us nicely into other estimates, shall we call them, that are being made around oil demand then, Kriti, with the IEA out with two different scenarios about what might happen, depending on how many EVs we all buy.
Yeah, two different scenarios. The energy story is so fascinating because they're dealing with so many different issues. We have an OPEC outlook that's coming out later as well, so that might actually give a little bit more insight. But the IEA, one of the scenarios, is actually a bullish one. So the idea where you are starting to see the consensus be that this is an oversupplied market, you're going to see Brent and NYMEX trade in a range. The IEA is saying, well, actually, there's another option here to do that. The other piece that caught my eye over the last couple of days, actually, has been the idea that as we're talking about sanctions when it comes to Russian oil companies like Lukoil, et cetera, there's also been more kind of attacks on refineries in the Russian energy infrastructure, and that hasn't shown up in the price. And that speaks to the idea of surpluses as well, because they're targeting refineries and not necessarily the actual production source.
Yes, and that's something we might get to talk about a little bit later on with Amrita Sen, the role of Lukoil International and the sanctions that are going to be put in place and what impact that has from refineries to drilling in Iraq to gas stations in parts of the east coast of America. You know, this is a business that goes quite far. It's interesting that there is so much riding on the rate of adoption, the policies around EVs and the rate of adoption around EVs. And as COP30 gathers in Brazil, probably this IEA report makes sobering reading. The fact that they've gone from having 3 scenarios last time that all peaked this decade to 2 scenarios, one of which doesn't peak until 2050.
Let me throw a bit of cold water on the kind of the more positive outlook. I'm going to channel my inner Alex Steele here and talk about prompt spreads. Okay? Prompt spreads. First, second month when it comes to the WTI contract, they're basically balanced at the moment. We are still in backwardation, but it looks like we're going to flip it to contango possibly very shortly. What that would signal is basically front month below kind of further out months, but the 2 nearest months are going to be basically in contango. That is a really negative signal.
That's a soft demand.
That's a soft demand story.
Yeah.
And so the market is signalling soft demand.
Which is where the market has been, to your point, Kriti, where the market has been focused for so long, despite all of these other stories that we keep talking about.
It's the consensus call across the board, but again, when everyone's consensus, it begs questions of who's wrong. And maybe the IEA is flagging the contrarian story.
Anika Gupta is going to be joining us very shortly. We'll talk to her about what is happening in these markets. Director of Macroeconomic Research at Wisdom Tree. Mark Dowding, we've already flagged him a couple of times, fixed income CIO at RBC Blue Bay Asset Management. Lots to say on what is happening in terms of the AI data center build-out. We need to talk about gilt. We need to talk about the Fed. We've got lots to talk about. We'll have a long conversation with him. Sharon Bell will be joining us as well, Senior European Equity Strategist at Goldman Sachs. Market Open is when we're going to see her. And Amrita Sen, talking of energy, is going to be joining us a little later on in the programme. Second hour, Energy Aspects founder and director of Market Intelligence.
In the meantime, plenty of data, comments, commentary to look ahead to today. At 12:05 p.m. UK time, the BOE's Hugh Hill is going to be speaking, plus plenty of commentary coming out of your area finance ministers. That meeting happening at 1 p.m. UK time. At 5:30, I should actually throw in there as well, about 2 p.m. UK time, 3 p.m. in Paris, there is going to be the start of a potential vote. We're going to discuss that later in the show as well. The UK's Fed Myron speaking at 5:30 p.m. UK time. But then it all kind of leads, there's an auction in there, all kind of leads to this House vote on the shutdown with a fun twist. There's a very fancy dinner happening at the White House. Wall Street executives, from Jamie Dimon to some of these other peers, they'll be dining, not at the ballroom, but certainly in the White House.
Yes, indeed. So we've got lots of Wall Street executives arriving at the White House, yes, for dinner. Things that they might want to celebrate, I suppose, tax cuts, reduced regulation, things that may be still on their minds.
Why does Trump want dinner with these guys, is my question.
Investment, maybe? I mean, that's what happened when he got all the tech leaders together.
OK, fine. But that feels like the old story to me. And I wonder whether the new story is he is worried about the midterms. He is worried about what just happened. The strategy maybe from the Republicans is to try and put as much money in people's pockets over the next 12 months to try and maybe head off some of the gathering Democratic momentum that we are seeing. So I don't know, but that would be maybe my take on this.
He's also drawn a link, though, between the shutdown and the difficulties that the Republicans had at the last elections, special elections. And, that's not something that Wall Street's going to help with. But we might see progress on that anyway.
Well, I also wonder how much of this, I mean, dare I say this, is this a little bit of a gut check as well? We know Jamie Dimon's words hold a lot of weight. If there's pushback against the tariff story, the Supreme Court story, the $2,000 dividends, the 50-year mortgage, some of these ideas that have been floated over the past couple of days, I imagine we'll get some commentary on all those fronts. OK,
what else do we need to know? What is it, Wednesday morning? Let's talk through the issues that we are watching. Aides to President Trump have spent the days following Zohran Mamdani's victory in New York apparently looking to review federal funds that will benefit the city, potentially suspending or cancelling those funds, according to the stories that we are looking at. That's according to a White House official who spoke to Bloomberg. The administration is waiting on Trump to greenlight any funding freeze. Bloomberg has learned that allies of Keir Starmer here in the UK are privately accusing the Health Secretary, Wes Streeting, of plotting to oust and replace the Prime Minister. Reports of internal feuds within the Labour Party cabinet have begun to surface, just 2 weeks, of course, before the government is due to unveil its highly anticipated budget. A spokesperson for Streeting described the claims that the minister was after Starmer's job as categorically untrue. Yes, Prime Minister springs to mind. If you want to think about, of course you're going to deny it. Debates over France's 2026 budget are also dragging on in Parliament. Lawmakers will spend the day discussing the Social Security financing bill, with a vote on suspending the 2023 pension reform by the end of the session likely. The vote is seen as a decisive part of the survival plan of Sébastien Lecornu's government.
Coming up. Yes, important. We'll continue to watch that French narrative as it unfolds. Coming up on the programme, ABN Amro announced it will be purchasing NIBC Bank from Blackstone today, this alongside quarterly earnings. We'll check in on the Dutch lender at the market open. Plus, we'll also keep an eye on German pharmaceuticals and biotech businesses. Bayer has been reporting numbers, the company reporting its earnings that beat estimates. Up next, markets find optimism in the latest private labour data out of the United States, in the sense that it was a bad report. Maybe that means more Fed rate cuts, and hopes of an end of a shutdown also prompting perhaps a little risk appetite. US futures pointing higher. If you have questions for our guests, if you want to get involved in any of these conversations, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade, 17 minutes past 7 here in London. The European futures picture looks to be suggesting a bit of positivity at the start of trade. Not everywhere. Some markets may underperform, but certainly the focus is on the upside. And US futures also pointing higher. NASDAQ futures looking a little different to yesterday's session, up by 0.5%. Let's talk about fixed income markets, though, and how they've been responding to the data in the States. Treasuries rallied after private measures of US economic data pointed to a stumbling jobs market. Let's bring in Bloomberg's Valerie Titel with more. Val.
Look, we did get that weekly ADP figure. Now, note this figure is only something that's been released in the last few weeks, but it did confirm that the U.S. labor market is continuing on a weakening track, and that led to a substantial rally in Treasury futures yesterday, and we're seeing it in cash this morning as they reopen after a holiday. Those two-year yields down by 3 basis points. The market is pricing in now around a 70% chance that the Fed will cut in its December meeting on December 10th. The data also yesterday did point to some dimming of small business optimism. We saw confidence dropping as well. And this is tied into the labor market story, too. Small businesses reported this weakening confidence on the back of worries about labor quality. Now, I want to also mention that we could have some perhaps more pressure on the Fed to continue its rate cutting cycle. Trump is hosting Wall Street executives tonight in Washington for a dinner. The CEOs of JP Morgan, Goldman Sachs, BlackRock, and Morgan Stanley are said to be in attendance. Now, Trump has used these dinners in the past in order to get business leaders on his side. Will he be trying to get Wall Street on his side in pitching that the Fed's path for interest rates should be markedly lower from here? Perhaps also he could use this dinner to get Wall Street on his side when it comes to the debt financing boom that is coming out of AI. We know that this data center investment is leading to these debt deals. We had it from Oracle. We had it from Meta. Does perhaps Washington need Wall Street on its side in order to get these debt deals done? I did want to tie this into what we heard from the AMD CEO yesterday. Shares of AMD jumped near 5% after hours after we heard the CEO, Lisa Su, talking very positively about continued acceleration in data center investment. She was saying that the biggest owners of data centers are telling her they're not pulling back on investment. They're accelerating it into the fourth quarter. Guy?
Okay, Valerie, thank you very much indeed. Ties a lot of themes together there. Let's talk about where we go from here. Anika Gupta, Director of Macroeconomic Research at Wisdom Tree, joining us now. Anika, we're about to see the end of the shutdown. That potentially is the story of the day. We're going to get a data deluge. It potentially could reframe these markets. How are you thinking about the next few days and maybe the volatility that could be coming towards us?
Yeah, it's going to be an interesting turn of events. I mean, we've been in a in a data abyss for the last 4 weeks, and clearly, more and more indications are pointing towards weakness in the labor market. And given that is the case, investors are now pricing in a higher probability of the Fed embarking on a rate cut in December and further easing of monetary policy. So, given that narrative, we do expect there to be more of a risk-on sentiment, given that we're now pricing in a higher probability of the Fed easing policy.
Do you think that's right, though? It's fascinating that there is this debate, this hawkish debate that is taking place on the fringes of the Fed at the moment, maybe not the fringes, towards the centre of the Fed, about whether or not inflation actually remains the greater threat. The Fed feels very divided at the moment. Is the market over its skis in its certainty that that December cut is going to be delivered?
Well, I don't think the market is over anticipating a Fed cut for December. I think, based on some of the data that we have been getting on the labor market, the numbers are expected to deteriorate quite significantly, and hence they would be right in order to, try to bring about a bit of stabilization. I think broader picture, for most of 2025, we have been trading on trade uncertainty owing to the tariff announcements. What we've seen over the second half of 2025 is as these trade deals are getting signed, it's providing a better anchor for the markets. We're also seeing, quite a strong optimistic picture emanating from the Q3 earnings season. That's also giving markets a bit more comfort in terms of the numbers and how corporates are actually navigating, the higher tariffs that companies are facing. So I think the macro picture still remains quite optimistic with, earnings being delivered by companies, with the US tracking an average earnings growth of about 14%, which is, above the expectation we had prior to entering the season. So I think, given the seasonality, given the fact that we finally are expecting to come out of the shutdown, the Fed easing cycle, gathering pace, it is an environment for a risk-on market.
Well, Anika, it's Kriti in London. Thank you for your time this morning. When we're talking about the case to actually make a rate cut in December and, of course, in 2026 as well, it's coming at the same time of conversation in Washington and across the United States of more fiscal stimulus, of ideas of a $2,000 dividend payment to all Americans. And I imagine that, of course, that hasn't been backed up yet of how the math actually works on that. But you can see the sentiment is showing up. He's even talking about a 50-year mortgage to try to get affordability down. If that's the concern of the White House, are there other measures that are maybe going to be coming to the fore that would eliminate the need for a rate cut so soon?
No, that fiscal concerns of the U.S. economy remain the big overhang. This is why we have seen a much weaker dollar in 2025. And, this is why we've also seen a lot of those safe haven flows come back in. So that remains a predominant concern. And obviously, we have the big, beautiful bill coming into fruition in 2026. And that's also going to weigh on fiscal concerns emanating from the U.S. market. So I think that will broadly provide a very important anchor for safe haven flows into, precious metal markets, as we've seen in 2025.
Anika, good morning. I was looking at some analysis yesterday of earnings reports, earnings season so far, and it suggests this is analysis of audio attached to earnings reports, and it says that CEOs have sounded their least worried about an economic slowdown since 2007. So we've got CEOs in the US not worried about a slowdown, but jobs market data suggesting that we're seeing layoffs. I wonder if that's just a mismatch in timing or whether something structurally interesting is happening here where growth continues but with fewer jobs.
Anna, we've seen quite a few concerns coming out of the earnings season. While, we're seeing a broader, higher average earnings growth of about 14%, there are sectors of the economy that are providing more signs of a K-shaped economy, where the lower-end consumer is struggling. That's been quite evident in the consumer staple stocks, in the restaurant stocks that are trading at 52-week lows, and that continues to reverberate back to consumer sentiment. So it is filtering back, and it is resulting in some of those weaker retail flows that you're getting in, coming into Bitcoin and crypto markets. You do see that filter through. So I wouldn't say it's been an earnings season where all sectors have been performing at par. I would definitely say there is a bit of diversification and a divergence between obviously the mega cap tech stocks, which have done a lot better, with a much higher average earnings growth rate around 27%, whereas the rest of the market are grappling with trade tariff uncertainty alongside the fact that, the lower-end consumer is struggling.
All right, Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree. We thank you so much. Guyana, I feel like what I learned from that conversation is that there is actually a decent case for a rate cut. And I know there's kind of consensus here, even though we're hearing perhaps different from the Fed governor. But she makes a key point. It makes it easier to service the deficit. That's what I heard out of that.
Right. And she's very focused on the weakness of the labour market, it would seem, in some of the data, the Challenger report, for example, yesterday coming through. I was interested in what she had to say about, we talk a lot about K-shaped consumption in the States, but the K-shaped earnings story out of the States, I think, is something that perhaps will gain momentum.
What you're talking about is monetary financing.
Not me, the world.
Yeah,
Wall Street.
but basically, is that what we're going to end up with? David Solomon was pointing out some big concerns that he has around what is happening with the debt story in the States yesterday.
It's a temporary fix to a long-term issue. Coming up, we're going to continue the conversation around the debt conversation, how it relates to the rest of the world. This is Bloomberg.
Wednesday morning, 30 minutes to the start of equity market trading here in Europe. Futures are largely positive. It'll be interesting to see how the FTSE 100 trades this morning. You could see a little bit of volatility around that market. BAE Systems is out with numbers. You've also got an oil story you want to factor in there. But the CAC's positive ahead of a key vote. Euro Stoxx 50 up by 0.5%, Chrissy.
Meantime, let's get a quick check on this bond market here. We're looking at 408 over in the States on the U.S. 10-year. When you look at the European picture, not a ton of movement, virtually unchanged. But, of course, we are barreling towards a French vote later in today's session. So maybe that'll shake the bond market up.
Yeah, to do with pension reform, isn't it? And that's obviously a key part of whether they get the budget through. Let's pivot to what's going on in where AI meets debt markets. Big tech companies are selling corporate bonds to fuel their AI ambitions. The likes of Amazon, Alphabet, Meta, Microsoft and Oracle have raised $93 billion this year, more than the previous 3 years combined. But as a debt-fueled AI investment boom takes off, many are worried that a tech bubble of some form is forming. Despite concerns, Bloomberg opinion columnist Julie Wren says bond traders have not lost their cool yet. She writes creditors are still demanding extra yield to fund the AI infrastructure build-out. It's a sign that we are not in a bubble yet. Joining us now with his thoughts, Mark Dowding, fixed income CIO at RBC Blue Bay Asset Management. There may be many... Good morning to you, Mark, first of all. There might be many ways to define a bubble and whether we are in one or not. You could look at stocks. Maybe Shuley's focused more on what's going on in debt markets and the demand for debt there for AI build-out. What are your thoughts on whether things look bubbly to you right now?
Well, I think you need to differentiate. I think in many respects we're seeing a boom, aren't we, when it comes to actually the money being deployed in the AI space. Projections next year that we're going to see $300 billion of spend. That's a huge amount of money to be throwing at an economy. It's the reason why US growth is going to accelerate next year, not slow down, what with rate cuts, tax cuts and deregulation coming down the pipe as well. So from that perspective, I'd say that we're actually in an AI boom when it comes to the spending that's taking place at the current point in time. But I think you need to differentiate between that and what's happening in financial markets. What's happening in financial markets, obviously with valuations, is a very different story. And that's where we're talking about bubbles, perhaps, when it comes to some of the valuations of some of the stocks that we're looking at in the equity market.
And let me take that thought a little further, because you make the link there between US growth and the AI boom that we're seeing, and then into continued expectation of Fed cuts, which raises some questions. I mean, do you see that the Fed will cut into this boom in AI spend?
Yeah, so look, they're likely to cut in December because in the short term, the data has been a bit soft. But into 2026, I'd contend that you could be looking at a year where you could see 3.5% real growth. On top of that, everyone who I speak to who's sensible in DC would tend to suggest that inflation's more likely to be going up rather than down. So let's put inflation at 3.5%. That's nominal growth of 7%. If you've got an economy doing that, you're not really cutting interest rates during the course of next year. And I don't believe whoever is going to succeed Chair Powell is going to come in as a Trump patsy just to deliver what Daddy wants. I think ultimately what we saw in the elections last week is that inflation affordability matters when it comes to US politics. So the last thing they can really afford in DC is runaway inflation to occur. So I actually think there'll be fewer rate cuts than a lot of people think next year.
Mean? Fewer, like, if we don't get December, how many do we get next year?
I think we may get none, to be honest, Guy.
Okay, so we're done. So
I think we may be one more and done. I mean, that will put rates at 3.5 to 3.75. Compared to that to where nominal growth is, these are normal levels of interest rates.
Where's the 10-year on that?
I think more or less where it is today. I wish I had a more exciting story.
No, it's fine.
But the interesting thing is there'll be a lot of people who started their financial careers after 2008. They look at interest rates today and they say they're way too high because their point of reference was what we saw in the last decade. But those of us with no hair, with longer memories, we probably look at where interest rates are today with the economy doing what it is. We're probably saying these are pretty fair levels of interest rates and bond yields. No big cause for these to be moving in a long direction, it seems, in the months ahead.
If the Supreme Court throws out Trump's tariffs, do you think we could get the 10-year back to 5?
I don't think so. I think that there's a good chance, you look at the poly market, there's a good chance, a 70% chance, that they actually vote this down. However, what you hear, speaking to the administration as we do, is very much, if these tariffs are thrown out under IEEPA, we're just going to be replacing them with other tariffs in their place. They need that revenue in their budget.
So it's a tax?
So it's a tax. It's always been a tax. Effectively, it's a pseudo-VAT that exempts domestic production.
Effectively, it's a tax. But then is it counteracted by, again, you mentioned the affordability thing, all of the fiscal boom that you're seeing in the AI, the dividends, the subsidies, everything he's promising here, including, I mean, the obsession for me is a 50-year mortgage because I actually do care about home buying and can't seem to afford one. But I think this is crucial, though, because he's talking about that. It's not being reflected in this bond market. Why not?
So if you think about the bond market, I think the one thing that you would say is that as high as the US deficit is, you're actually in a situation that, thanks to tariffs, it's actually on a downward trajectory now. You've actually got the deficit going down from 7 to 6, still far too high. But the one thing that you can say is that when you've got 7% nominal growth, even if you have a 6% deficit, your debt-to-GDP ratio isn't climbing. Where you get really hurt as a debt investor is if you have that accumulation of debt and you've got no growth to go alongside it.
7% nominal growth sounds like a great story for equities, though. Like, that is an economy that is in some ways ticking along very nicely.
I mean, one would argue that that's exactly what this rally has been about this year, and therefore there's a little bit of... Exactly. There's a little bit of cold water that's maybe due to be thrown on that. There's an argument in the credit market, though, that because of all these fiscal debt worries, not just in the United States, in Europe as well, and in other parts of the world, you're starting to see fund flows go from the sovereign space to the credit space, one that could ultimately end up in 6 months' time as creating oversupply of issuance. Is that a risk in your mind?
So I think, firstly, one thing I would say quickly is that fixed income investors today, they want carry and they want yield more than they want duration. And so that has been driving a move more in a secular fashion into credit. Otherwise, the one thing that you would say is that we've seen strong demand, but we're seeing a lot of supply. Some of these big companies, as you mentioned earlier, they were big cash cows, cash generators sitting on piles of cash. They're the ones now at the vanguard of those who are splurging that cash in this AI investment. That's creating a lot of bond market supply. That becomes a bit of a barrier for yields to rally further and further credit compression. But I don't really buy the cockroach idea from Jamie Dimon. I think, bluntly, we've had a couple of instances of corporate fraud, but we're not looking at things like we were looking at the end of 2007, where you could see proper cracks developing in the credit market.
Well, that's in the private credit space. So in the public credit space, which I realize is all kind of one supply pool, I understand that. But when it comes to kind of the issuance story, whether people actually want to be buying, whether it's long duration or even treasuries, for example, is there a sentiment here that why buy the U.S. Treasury when you could get an Oracle data center bond for more yield, but perhaps more delivery? Is that thinking, or is that trade-off happening?
Well, I think bluntly, that trade-off has been happening over the last several years. That's a factor that has seen
since COVID.
IG spreads effectively at a 20-year tight in terms of the index.
But is that too tight?
Well, the one interesting thing there is if you actually look at the valuation of corporate bonds relative to swaps. Sorry for getting too technical on you at this time in the morning, but if you look at the valuation relative to swaps, you're actually still about sort of 15 basis points wide of where you were in 2021. So I think what you can see there is it's less of a story about corporate bonds getting truly expensive. It's partly the fact that government collateral is cheapening up relative to everything else, and you see that in the swap spread.
Mark, we can't let you go without getting your views on gilts and the UK, because you always have lots to say on the subject. Wes Streeting, excellent reporting by our team overnight, talking about Wes Streeting plotting against the Prime Minister. He's out denying it with some extraordinary language, criticising the Prime Minister's team, saying it's just not true. I also don't know where Lord Lucan is, and I didn't shoot JFK. So JFK suggesting that this is all conspiracy theories. Would this be important to gilt markets if we saw one of the top two in the Labour Party replaced?
Well, I think the first thing you'd say in these sorts of situations, no smoke without fire, right? So, of course, you're coming out with those very robust denials. But I would say that from an investor standpoint, from a gilt market standpoint, the big concern here is if we do lose Reeves, if we do lose Starmer, it looks like the Labour Party is more likely to be lurching further to the left. We're likely to go down the path of even more spending, even more taxation. Even
if Streeting is more of a centrist, that is, well, a right of the left.
Well, that's under the assumption that he would win in a leadership election, and I think there's a good chance that you could end up with him as a stalking horse and actually a candidate more in an extreme position actually winning the day. But I think the concern here in the bond market, and the one thing that I'd say fundamentally is that Labour is pretty much committed to signing us up to 30 billion plus of tax hikes at the forthcoming budget. I think that the gilt market would be totally happy if they did nothing on tax whatsoever on this budget, if only they could demonstrate they could deliver $5 billion of spending cuts. Because as gilt investors of the bond market, we don't care what the OBR thinks. It's what we think that really matters. And what we think is that actually cutting spending is more important at this particular stage with spending on this upward trajectory than forever rising taxes. So there you go.
For heaven's sake, don't tell the Labour Party. Are you buying or selling gilts into this budget?
So I don't have a strong view on gilts. The one thing I would say, though, is I'm concerned that there's a narrative here that Reeves could end up trashing the economy, pushing the UK economy towards a recession in 26, maybe in the vain hope that actually that gives her money to spend later in the life of the Parliament, and actually voters have forgotten as you go to the polls in 2029. But that idea of trashing the economy in 26 means rate cuts is bad for the pound.
OK. There we go. Set it all up nicely. Mark, nice to see you. Always a pleasure. Mark Dowding, Fixed Income CIO, RBC Blue Bay Asset Management. Thank you very much indeed. Wednesday morning, coming up, chip stocks firmly in focus this morning.
2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26.
It will not end in 26. The CFO of Infineon talking to me earlier. Infineon, very much one of our stocks to watch as we head towards the open in 18 minutes. This is Bloomberg.
$15 minutes away from the opening trade. And you look at the futures picture, I mean, green on the screen across the board, except for the FTSE 100, virtually unchanged there. We'll get into the details as we get closer to the open. In the meantime, a focus on the tech space. On High Precision Industry has reported better than expected quarterly profit thanks to accelerated AI-related spending by major tech firms. We're here and joined now by Bloomberg's Tom McKenzie, our Bloomberg Tech Europe anchor. Leslie, he does tech. Walk us through what On High has to say on that front.
He does tech. Yes, indeed. Well, they do tech as well. Interestingly, I mean, it's not about the iPhone anymore. Hon Hai used to be all about, Foxconn City in Shenzhen and in Zhengzhou in central China and churning out iPhones and Samsungs as well. It barely gets a mention. This is all about AI. It's all about the servers. It's all about data centers. And this is another, in the bull case for AI, this is another tick in the box coming through from Hon Hai. So they came through with third quarter numbers. Profits just shy of $2 billion, $1.9 billion, comfortably above the estimates. And they're seeing huge demand for the kit that goes into those AI servers. They expect that to drive revenue growth into the double digits. And interestingly, the chairman of Hon Hai was saying that 2026, AI will be the most important growth driver for this company that, again, has traditionally and historically got most of its revenues from producing iPhones and iPads. Also saying that they are involved in the sovereign AI story in the US and Japan as well. So yeah, a tick in the box if you're a bull on AI and you're looking into 2026 from Hon Hai when it comes to what they're putting into data centers.
AMD,
another tick in the box. The question I have is why they've come out with an update 2 weeks after their earnings. I haven't quite gotten to the bottom of that, but the numbers are much more robust than they were on the earnings a few weeks ago in terms of the projections, the 3 to 5 year projection, revenues of increasing more than 35% in terms of revenue growth projections, more than 35% over that time frame. Margins, interesting as well. They expect margins to increase by 35%, to exceed 35% over the time horizon, the same 3 to 5 year time horizon, and AI data center revenue to increase by 80%, profits per share, more than $20 a share. So all these numbers coming through from the CEO of Lisa Su yesterday of AMD, underscoring optimism in terms of the outlook for a company that's getting close to having about 10% of the market share for these AI accelerators, having struck these deals with OpenAI and Oracle.
But the story, essentially, that was part of the story yesterday. The other bit was the fact that SoftBank was selling Nvidia.
Well, that was literally going to be my next question, because you have these pockets of excitement around AI, but then you look at SoftBank's take. You look at TSMC, I think, came out with a kind of a skeptical take on what the future of AI demand was. Well, so there are pockets where you are starting to see a little less enthusiasm.
So I mean, SoftBank saying that this is all about freeing up liquidity that they can continue to spend on AI infrastructure, for example, the Stargate project. But certainly, it was eyebrow raising that they've sold out not just a portion of their stake, but all of it.
Yeah.
I mean, $5.8 billion on its own is not a small number, but obviously in the category of a market cap company, Nvidia, of more than $4 trillion, is a drop in the ocean.
What do you make of this depreciation story? Because this kind of ripples back into all of this. The fact how quickly do you depreciate a chip? I've heard anything from 2 to 6 years.
So this is what Michael Barry has been talking about, and this is what Cameron Price has been talking about in his opinion column today, which is well worth reading, because he's kind of done a historical analysis going back to the beginning of this century on depreciation and the spend on capex and how that has adjusted with the hyperscaler spend. Look, the depreciation is real, and so there's a real question mark: is are they marking this correctly, the hyperscalers, in terms of how quickly these AI assets, particularly the AI accelerators themselves, the chips themselves, actually depreciate in value. So you can sink $100 billion into AI accelerators 1 year. They're not going to be worth that amount 12 months later, and then you push out 3 years down the line. So for the accountants out there, that is a question worth scoring over. Are they marking it correctly? Is a question that Cameron Price in his piece today is putting on the depreciating AI assets, and whether that's going to become more of a concern going forward.
Tom, thank you. Tom McKenzie with the Tech Beat this morning. Let's widen the conversation, talk about the markets in 3 minutes. Joining us, our Bloomberg Executive Editor for Asia Markets, Paul Dobson, who has a head start on us here in Europe. Paul, very nice to see you. Thank you for joining us. So let's talk about Treasury markets. We've got Treasuries responding, it would seem, to the weakness in the US labour market data and further expectations of rate cuts from the Fed. Anything unusual in the moves this morning?
Oh, well, absolutely, Anna. It's unusual that they move so much in our time zone, but the reason is that the cash bond market at least was closed yesterday. So this is the first time that the Treasury market is able to respond to those ADP figures, showing that continuing trend of a weakening labour market and giving the market, therefore, a little bit more confidence that the Federal Reserve will go ahead with another rate cut in December. It's still very split among the Fed's speakers, right? We hear from some of them talking about the concerns about sticky inflation. We hear some of them talking about concerns about the labour market, and what we really need to know is which way is that middle ground, the middle patch, which probably includes Jerome Powell himself. Which way is it going to turn? And so I think it's going to be really interesting if we do get the US reopening, then we'll start to get some of the official data trickling through as well. We'll get probably September labour data as one of the earliest indicators, and that's going to give us some fresh signals, but it's also probably likely to give us more volatility. At the moment, though, lower yields, a little bit more hope that the Fed will cut again.
Paul, am I watching my yen screens for intervention? Is that next?
Yeah, I don't think that we're that close yet, but there definitely is that sense the government is getting a little bit more worried about the yen. And no surprise, it's at a weakest level since February today, continuing to dribble, approaching 155. Now, the Japanese officials tend to have a couple of rules of thumb that they use to judge when they would actually need to take physical intervention, i.e. stepping into the market and buying the yen to sort of stabilize things. Either a 10 yen move over the course of about a month. We're not really at those levels, not until we get towards the 160, depending on how much you squint at the chart, or a 4% move over the course of a couple of weeks. And again, we'd need to get up into the 158 levels, something around there, before they come in. Nonetheless, the rhetoric that we're getting, the pushback that we're hearing from the administration, from Katayama, the finance minister, is getting louder, and the yen is still under pressure as well. So one to watch there.
Let's circle back to a conversation we actually just had with our colleague Tom McKenzie. But Paul, there's a lot of concern about what the SoftBank's selling of Nvidia's stake actually means. What's the take in the region?
Yeah, I am going to be completely honest with you, Kriti, and don't really know. And that's why I think it's so fascinating. And I heard your debate with Tom about it all, and I think that you covered a lot of the salient points. But the fact of the matter is, in the ADR market, so in the US trading yesterday, SoftBank was up. Today, it really bombed at the open, and it has been starting to come back again. But there's all of this uncertainty about how exactly do you value these AI companies at the moment, including OpenAI, which it holds and wants to invest more in. At least it's sort of like, managed to cash in on Nvidia, but then people are saying, well, is that some sort of sign that it worried that it's at the top, or what's it going to do next with its resources? So all of those AI valuation issues still playing out in the background, even as the market continues to rally.
Lots to keep an eye on. Bloomberg Executive Editor for Asia Markets, Paul Dobson there, giving us a little bit of a world tour from FX to technology. We thank you so much. Let's do a little bit more on the corporate space, get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with Infineon today after the chip maker said that it expects revenue to return to growth next year thanks to really strong momentum in AI infrastructure and AI data centers. So let's see how the stocks react to that this morning after what has been quite a lot of up and down for that stock. Interestingly, the CEO said that although there was this huge boost from AI infrastructure, there was still some weakness in some of the other key end markets like automotive, which is a really big part of the business for Infineon, but also industrial and consumer. So we'll see if investors focus more on this AI boost or the weakness elsewhere. Moving on to some M&A, and ABN Amro in the Netherlands is buying NIBC Bank for 960 million euros. So that is in a bid to expand its footprint in the retail banking space in the Netherlands. It also has reported that this morning ABN Amro a profit ahead of estimates. So we've got two sets of good news this morning, and we'll see how much of a boost we get. We've already seen a very impressive run for that Dutch bank so far this year. And finally, SSE, the renewable energy provider over in the UK, is planning to raise £2 billion from investors to fund major investments in grid and renewable energy. This is reminiscent of the equity raise that we saw from Ørsted, another energy company in Europe earlier this year. We'll see how much that gives, how that reacts this morning. We have seen quite an impressive run for that company over the last few months. Let's see if that continues today.
Chloe, thank you very much. Our equities reporter, Chloe Melly. So there's some corporate reporting we certainly need to pay attention to, but big picture, I mean, US futures are pointing quite a bit higher, NASDAQ futures, as if they're trying to recover a little bit of that lost ground from yesterday.
Absolutely. It's going to be a bumpy day, though. It'll be interesting to see. We could today get clues as to how the data is going to be delivered over the next few sessions.
There's not really much shutdown news right now, is there? No. It's just as if they were just expecting that to happen. And
a lot of anticipation, excitement in Washington. The opening trade is up next. Stick with us. This is Bloomberg.
Wednesday morning, good morning. How are you doing? Let's talk about Tuesday, and then we can talk about Wednesday and figure out what cash equities are going to look like when we open in a few minutes' time. This was the S&P session yesterday. As you can see, Europe went out kind of beginning of the session, down near the lows. We rallied after that, despite what was happening with Nvidia and SoftBank and all the other good stuff around the AI trade. So that's the kind of setup for this morning in terms of what we've still got to price in. We've probably explained a little bit as to why we are seeing most futures in Europe when it comes to the indices looking fairly positive this morning, Kriti.
Yeah, looking fairly positive, to your point, everywhere but right here in the UK, unchanged for the FTSE 100. Some massive underperformance relative to what you're seeing, one, in Euro Stoxx 50 futures, but also relative to the CAC and the DAX. DAX is higher by about 0.6% on the futures picture. The CAC is higher by 0.5%. Remember, Anna, they have, of course, a vote in the National Assembly around pension reform later today. We're going risk positive into that, at least as things stand right now.
Yeah, let's have a look at where we are on some individual stocks and sectors in focus then, Kriti. And energy could be in focus. We've had an interesting IEA report out. Two scenarios being painted. They don't declare which one they think is more likely, but they've reintroduced one that has oil market demand not peaking until 2050. So that could be of interest to those in the energy markets, at least. Infineon is certainly in focus. They see 2026 revenue growth as AI outlook boosts sales. That's a headline from our story, and it does seem to be something of a turnaround from a business that was very much focused on industrials and autos into something that is more zeitgeisty now, of course, and focused much more on AI. ABN Amro also in focus. We had numbers out from them today. ABN Amro's NIBC deal is not enough to offset slow growth. That is the conclusion of some of the analysts who've been poring over the details, Guy.
OK, here we go. Time for the Wednesday session. Is this the day we see the shutdown ending in the United States? Are we waiting for that moment a little bit later on? At the moment, what we're looking at is a positive story emerging, except for the FTSE 100. It is expected to open reasonably flat this morning. BAE Systems is out with numbers. Keep an eye on what is happening with the miners and the oil stocks as well within that market. FTSE 100 flat as a pancake, as anticipated. Nothing to see here. Let's move on to some other exciting markets, which are about to open, I promise you. Looks like we're getting a slow start to the day here in Europe. Look at what's happening with Infineon in Germany. That's going to be an interesting story this morning as well. The banks are firmly in focus. The IBEX is up by 0.3%. We need the CAC to open. We need the DAX to open. I'm quite interested in what the Italian market does as well this morning. There's a few things going on that we need to focus on. I can't give you the details because they're not open yet, but I'm sure Kriti's got some other factors we need to fold in.
I always do. I mean, I think what's shocking to me right out of the bat, and to your point, the CAC is not open yet, but a lot of French stocks are moving to the upside when you look at least some of the early reads on the stock 600. But overall, I'm seeing healthcare kind of in the lead right now. I mean, it's a pretty broad, you're seeing a fairly broad risk rally, but the healthcare picture certainly is key. You have Novo Nordisk, AstraZeneca. I mean, if there's a healthcare stock out there, it's up in the session today, Anna. Yeah, it's not the clearest picture coming through this morning, is it, in terms of markets, and the CAC and the DAX, both not yet open, so we're lacking some key components. There is some basic resource upside. We have iron ore prices going higher, so we do see the miners going a bit higher. Autos and auto parts, though, is the best performing sector this morning. Mercedes-Benz is one of the better performers. In the banking space, then, we've got ABN Amro responding to that asset sale, perhaps, up by 4.5%, so that was one that we flagged, and one that is on the move this morning. To the downside, then, it's media that seems to be the worst performing sector, and WPP is one of the fallers in that particular sector. Looking to see really whether the technology sector has much to say about
Infineon's not open yet.
There we go.
So we'll wait and we'll watch and we'll see what happens there. SMI is down by 0.8%, so maybe the chips are going to be under pressure. We'll watch that one. BAE Systems is a fairly big drag on the FTSE 100 in terms of the points. It is down by 0.5%. Actually, the earnings look like they're pretty much in line with what expectations were going into those numbers. But there's banks, there's luxury, there's a few chip stocks that are up. Actually, SML is up this morning. But as you say, it is maybe the pharma space that is delivering the biggest kind of upside bump for these markets this morning. But I'm looking at the names that are on this board, and I am struggling to deliver a narrative off the back of it.
Well, maybe we should get to someone who maybe can give us a little bit more of a narrative. Sharon Bell, Senior European Equity Strategist over at Goldman Sachs, joins us around the table this morning. Sharon, you've just witnessed our little detective work here this morning. I think what's really interesting, and gut check me here, we're seeing a lot of positivity into healthcare stocks that were quite battered in the last couple of months over tariff risk, the Swiss story, the drug pricing, et cetera. When you see a defensive trade in the States, it seems to be followed by this massive rally in healthcare. Is healthcare in Europe the equivalent of big tech in the States? How do you think about that?
Well, healthcare is a very big sector in Europe, and even though the European markets have done well this year, you're right, healthcare has been a bit of a detraction from that, a drag from that, because of its dollar exposure, but because of concerns about pricing, etc. But it got very cheap. And I did see back in August a lot of my clients were saying, actually, this now looks quite inexpensive. So I think that some of these point rallies in the sector, I think, are driven a bit by just if you're concerned a bit about taking too much risk in tech, healthcare is a nice offset to that. Plus, it's a bit of a cheaper sector now given the underperformance this year.
Well, we've had a couple of weeks where we kind of wake up this morning and we're saying, oh, well, the stocks that were down yesterday are the ones that are up today. Going into year end, is that basically what we're looking at, a couple of weeks of the rotation trade?
Yeah, I mean, it's difficult to find a narrative this morning, isn't it? I completely agree. You've got some defensives doing well, some cyclicals doing well. It's really, really mixed. What we actually have found in the data is that correlations between stocks have been very, very low in the last 3 months, meaning that it's actually been quite a stock picker's market. So it is quite difficult, I would argue, to pick a very macro narrative in all of this. Maybe that's because one day a set is up and then the next day they're down. But I think it's also because it's been more stock-driven rather than macro-driven. And maybe that's because of the lack of data in the US as well at the moment.
Are you broadly positive, though? What is...
Broadly positive, yes, because we think that next year, 2026, we will see better growth in the US, better growth in China and better growth in Europe. We think that tariffs probably have impacted growth this year in the US, not perhaps as majorly as many people worried, but there's been a negative from that. But we're also seeing the Fed cut rates, which should help growth next year as well, and probably a bit more fiscal expansion by Trump next year, all of which should be helpful for growth.
Is it going to be as good as this year?
I think that growth next year should, if anything, on our forecast, be a tiny bit better in the US than
So does the equity market do better?
I think the issue with the equity markets were already very high valuations.
Yeah.
So it's a struggle. The equity market's kind of priced some of that positivity next year already. So I think the equity market is unlikely to do as well. We've had incredible double-digit performance this year. A lot of it in the US has been driven by earnings, not just valuation, but valuation is already high. So I don't think it'll be a bad year for the equity market, but I think that it will be a better year for economic growth next year. The market's already priced quite a lot of that.
Okay.
Sharon, good morning. Can I pivot us to the open of the gilt market this morning, and we've got gilt yields rising a little bit more than they're rising across Europe, which turns are, I mean, that's often the case. It does often respond more to news. But that makes me look for drivers here in the UK, and we're thinking about a little bit of political turmoil and whether we might see some pressure on the UK government to prove it has a tight rein on spending. Anyway, whatever the driver, gilt yields are a little bit higher. And thinking about a read into stocks from that, how do you, what do you watch for at moments like this when we see spikes up in yields?
So, I do think the gilt market is incredibly important for stocks at the moment, probably more important than anything else. And the reason I say that is if this budget coming up is seen as gilt-friendly, then I think it will be very good news for certain slices of the UK market, particularly, obviously, more indebted slices like utilities, but also things like real estate, home builders, UK domestic stocks, FTSE 250. They will be very vulnerable in a period where gilt yields go up. Obviously, you have seen them underperform. Many of those slices underperformed this year because of concerns about the fiscal vulnerability of the UK. So I do think that having a kind of fiscally robust plan is what certain slices of the UK equity market need. But I say certain slices, and I emphasise that because FTSE 100 has had a very good year, but it's super international.
Yes, very different picture there. Of course, we're moving towards the budget. What's going to be in focus for you as we do that towards the end of this month, looking at, yes, the fiscal backdrop, but that it'll be the same sectors in focus, I suppose?
I think so, yeah. I mean, you could have a look at the budget and say, OK, there are certain measures that can impact particular companies and sectors. For example, you could see some taxes on gaming. There has been talk, although I think that maybe pull back on this, for the bank sector, the oil sector, for example, taxes on fuel, lots of other very specific things you could look at. And they could be important, but personally, I think the more important thing is the reaction of the bond market and investors, I guess, view on two things: how much the budget will impact growth. And we know that taxes are rising, but how much will it detract from growth? And then is it seen as providing that fiscal security, which means the bond market can rally on the news? If so, all those domestic slices I mentioned before, real estate, utilities, home builders, FTSE 250 can do well.
But is that tradable? I mean, come the budget's on the 26th, come the morning of the 27th, is that actually tradable? And I say this because we've had the same conversation happen in France and Italy and certainly in the United States as well. And it hasn't been something that's been reflected necessarily in the markets or in some of the heavyweight stocks of the various indexes. Is this tradable, the taxation policy?
Yeah, I think it is tradable for sure. I mean, if you start seeing a view out there that maybe with no spending cuts and not enough raising of funds, then there's concern about fiscal stability in the UK. You absolutely would see the mid-cap stocks, the UK domestic, all those related to UK rates like home builders, real estate, sell off. That is quite clear. If, on the other hand, you get a budget which is delivered and the market's confidence improves, then I think these types of names will outperform and do well. So I do think they turn on this particular factor.
If she raises taxes and growth slows down and the bank has to cut rates, is that, I'm trying to kind of wonder, how does that play out in terms of some of these stocks?
I don't think that, so it depends on your rate sensitivity. It's probably less good for the banks, for example, but it would be good.
Better for housing.
Better for housing, better for real estate.
But it's a slowing economy. These taxes are going. So if the gilt market reacts positively because she's giving herself a greater fiscal buffer, but the economic consequence of that is slower growth, is that good for UK domestic stocks?
Yeah, at the margin, I think it is. I know what you mean. There's offsetting things here. Utilities ought to benefit either way because they're a more defensive sector, less vulnerable to economic growth slowdown, and they would benefit if gilt yields go down. But most of the ones I mentioned before, FTSE 250, the mid-cap stocks in the UK, are also vulnerable to UK economic growth. Yeah. So I think on balance, I would like to see, for those types of slices of the market, I think you would like to see a budget that delivers fiscal stability, even if it does mean some drag on UK growth. I think that's well priced anyway, and expectation taxes are going to rise. It's going to be a drag on growth. We reckon a drag worth about 0.3% of GDP. So considering kind of trend growth in the UK is maybe one.
That doesn't sound like a lot, but if you like,
actually, it's a reasonable amount.
It's a big chunk.
Yeah. And thinking about what influences the growth story in some of these European economies, Sharon, takes us to maybe a more global conversation. I noticed that you've recently upgraded your European stocks view, but a lot of that is driven by US growth, maybe China turning a corner. Is it, or is that the wrong narrative?
I think it is certainly helped by that. European growth hasn't collapsed in the way that some people worried with tariffs earlier this year. So European growth has been okay, hasn't been stunning, and we've had lots of risk factors like French political risk, for example. But you've also got some news that next year you're likely to see more fiscal spend by Germany. China, definitely growth has again been less battered by the tariffs than many feared. US growth has been a little bit better as well. All of those things, in our view, mean that earnings can be a little bit better next year. We're probably going to see zero earnings growth this year for the biggest European companies. Next year, we think it'll be about 5%. Not stunning, but enough for us to slightly upgrade our forecast.
Sharon, great to see you.
Thank you.
Thank you very much for stopping by to see us. Sharon Bell, Goldman Sachs, Senior European Equity Strategist. Core 6 looks a little bit like this morning. Let's take a look at where the centre of gravity is here in Europe. And as you can see, there's a lot of positivity on the screen. Luxury is trading higher. Defence stocks are bouncing back. Chip stocks are doing relatively well. Infineon has been in negative territory and up by over 2.5% at some point in the last 11 minutes. So it's a choppy session, maybe for some of the chip stocks. Let's deal with the details of what we're watching. SSE is another name that really stands out for Chloe Mellet.
Good morning, guys. SSE is up quite impressively this morning after saying that it plans to raise £2 billion from investors to fund some key projects. So projects like wind farms in the renewable assets and also electricity grids. So that is an equity raise that is being received really well by the market this morning. And we have got SSE up 10.5% this morning. Moving on to ABN Amro, the Dutch bank is also up on the back of really positive earnings and also M&A. So it reported profit ahead of estimates this morning, and also said it is buying NIBC Bank from Blackstone for €960 million. So that will help ABN expand its footprint in the retail banking space in the Netherlands, and that is being received quite well by the market. We are up 2% for ABN AMRO this morning. Moving on to a sector that is struggling a little bit more, and that is the UK house building sector. So Taylor Wimpey reported this morning and said that the uncertainty around the UK budget and potential tax raises there was really hurting that housing market, and so that is dragging down the rest of that sector this morning, and we have got red across the screen for those house builders this morning. Moving on to RWE, and the energy company said that the trading division was recovering after being hurt by a lot of geopolitical uncertainty earlier in the year. So, you know, if we put that back into context, that trading division is still struggling, but it seems to be doing a little bit better, maybe back on the road to recovery, and that really reassured investors this morning. And finally, we have got Hiscox, which was also down this morning after being double downgraded by Jefferies with the analyst saying that it was lagging in performance behind some of its peers, Lancashire and Beazley, which are also UK-listed insurers. This is the only sell rating on the stock so far, so it's not doing that badly, but we are down 1.6% on the back of that double downgrade.
Chloe, thank you. Chloe Melly from our equities team. Coming up on the programme, we'll check in on what are the moves in this morning's session, making some modest gains. The German chip maker Infineon raising its revenue outlook for next year. We spoke to the company, Guy spoke to the company's CFO just earlier this morning. We'll hear from that conversation shortly. That's next. This is Bloomberg.
Welcome back. You're watching the opening trade. There's a bunch of stocks out there that we're focusing on. We've dealt with a few of them. SSE was a real standout story a few minutes ago for Chloe Melly. Let's turn our attention to what is happening with the chip space right now. Infineon, really choppy this morning in terms of the market performance that we're seeing. It's been actually in negative territory briefly and up over 2.5%. What is really fascinating here is that we're seeing basically one of Europe's big chip giants in transition. This is a company that has traditionally very much focused on the automotive sector, which has been a struggle for it recently. This morning, though, despite talking about kind of moderate growth elsewhere, they significantly at Infineon upgraded their expectations when it comes to the AI story. Now, they build chips that help with the data center build out, and that is where they see significant growth coming from here. The company's CFO spoke to me a little bit earlier on, just as the numbers were coming out. This is what he had to say about that AI story.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. last fiscal year more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space and in terms of being able to guide investors to what you are going to see next? How much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You also may be aware that we entered into an agreement with Nvidia to cooperate on the development of a total new architecture, which is 800-volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
Let's talk about what else we're seeing in 2026. You have, over the last few years, been, let's call it conservative in your guidance for what the further year is going to look like. Are you being conservative when you talk about broadly moderate revenue growth, broadly moderate growth in 2026? Are you doing the same thing again? Can I call this conservative?
Yeah, first of all, I would point out to the fact that under German corporate governance, we are not only guiding for a fiscal quarter, but for the full fiscal year. Secondly, if we look back into the way we have guided last fiscal year, we called it a qualitative comparable guidance. We managed well. So the guidance we gave in November, exactly 1 year ago, matched the real numbers pretty well, despite the fact that we have to digest a significant negative currency development. And from a philosophy, how we guide, we are not changing that for that fiscal year. But it is, if you go one layer deeper, there is a story of two tales. There is the idiosyncratic growth, the boom in AI power. On the other hand, as you asked in your question, Guy, there is on the automotive, the industrial, the consumer, there is some modest growth. And why is that only modest? Yeah, it is driven by this geopolitical uncertainty, by all the tariff discussions, which lead our customers to a very cautious behavior. They are ordering on very short notice. Therefore, we have baked all that into our guidance for that fiscal year.
The Infineon CFO, Sven Schneider, speaking to me earlier this morning. As you can see, the stock is chopping around all over the place at the moment. As I say, we've been up over 2%. We've been negative. We're now only up by 0.2% on Infineon. Do I take the kind of the moderate guidance on the broad part of the business as the main story, or do I take this kind of pickup that we're seeing in terms of the AI narrative and the upgrade that we're seeing there and the expectation for future revenue growth coming out of that space as the way I want to be looking at this story? Charles Shum, who covers semiconductors and electronics for Bloomberg Intelligence, joining us around the table. What do you make of the number? Where should I be looking this morning with Infineon?
I think the number actually quite match what we expected. As the CEO said, he's actually giving a very conservative guidance. I think that's because there's still some uncertainties on the future automotive and also industrial chip demand. Like he mentioned earlier this morning, there's actually still some destocking movement in the coming quarters, because there's still uncertainty that bring by the U.S. tariff. So that's something we have to consider. And also, if we look at the third quarter results, we see that actually, although the AI power demand actually is quite strong, but if you look at the breakdown, you look at the operating margin, actually it missed the consensus. That's actually could be a warning signal that maybe it's not that easy to turn the top line growth into the bottom line growth. That's the problem we should watch. Yes.
Very quickly, talk to us about Hon Hai as well, which is also reported. Some of the earnings also use that AI tag word. Thoughts?
Yes. Hon Hai also reported a very good result for the third quarter this morning. Actually, its operating profit actually beat the consensus by more than 17%, if I remember correctly. I think this is actually all contributed to the strong AI server demand, and also particularly it also gives a guidance on that its component business actually is growing very robust because actually we should look into this. I think this is partly a contribute to the consensus because it has a high profit margin on the component business.
Yeah.
And Hon Hai is actually also best known for being a OEM for the Apple's iPhone.
Yeah.
I think yes.
Yeah. Charles, thank you very much.
Okay.
Thanks for the update. Charles Schum from Bloomberg Intelligence with the latest on some of those tech names. Let's pivot to what's going on in the defence space. Modest gains also the story over at BAE Systems this morning, up by 0.4%. The company maintaining its full-year sales forecast in its trading update. So far, so simple. But there are some interesting things to talk about with the defence sector, of course, right now. Jerry Doyle joins us, Bloomberg's global defence editor. Jerry, good morning. Talk to us about order intake. That seems to be an area that they're quite pleased with, the order intakes at BAE.
Yes, they reported 27 billion pounds in orders so far this year. That includes 20 Eurofighter Typhoon fighter jets for Turkey. It includes Type 26 anti-submarine frigates for Norway. Those are big orders that dovetail nicely with this broader European defense spending we're seeing. So I think they're pleased with that and see some momentum with it going forward.
Is there another catalyst coming? We kind of know about, there's been this big defence sort of build out. You've talked about some of the Norwegian stuff and the orders that are coming through. Are there bigger catalysts coming? The Germans are about to start spending money. The UK looks like it's going to be excluded maybe from some of the defence spending that's coming out of Europe for political reasons, economic reasons as well. What's the next catalyst for BAE, or is it all in the price now?
It could be any number of things, like their involvement in MBDA, for instance.
Right, missile.
Yes, exactly. The missile business, they make a lot of air defense missiles. They make a lot of air-to-air missiles. Those are areas that Europe is expected to spend quite a bit on. So those could be areas that could help BAE going forward.
Is there a problem with the UK being excluded from this big fund that Europe, the EU, is putting together? At the moment, that's there's a lot of political debate about whether or not we should be playing a part in that.
It could be a political stumbling block for BAE. I'm sure as a business, they're just going to put their best foot forward. They're going to say, we have the good stuff and we're going to sell it, and they'll see what they can do.
Yep. Well, what's the political kind of story around that one? They're saying the price tag is too high at the moment. Jerry, great stuff. Thank you very much indeed. Jerry Doyle, Bloomberg's global defence editor. What are we going to talk about next? The oil market. The IEA has tempered its stance on imminent peak oil demand, reinstating a scenario where consumption actually keeps growing until the middle of the century. We're going to be talking about that next. Amrita Sen, founder and director of market intelligence at Energy Aspects, will be joining us next. Energy, next on the show. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session, green on the screen across the board. You started to see the FTSE 100 pick up a little bit of momentum as well. We started the session virtually unchanged. Now shares higher by 0.2%, but it pales in comparison to some of the moves that you were seeing in the DAX and the CAC. And the CAC is really interesting here. Of course, we do have that French vote later on today, but risk on going into it. The DAX, there's some earnings stories there. There's a tech bump that you're seeing. Guy, really interesting to see green on the screen yet again.
Defence stocks are also up, as are pharma stocks. 2-to-1 in terms of the ratio, up to down. You've got a volume story, though, that remains quite weak, and I think you want to keep paying attention to that. This is an unconvinced market at the moment, judging by the volume that we are seeing on a day-by-day basis at the moment. So we are on the front foot, so let's talk about some of the leaders at least. Let's start there and figure out with what is happening in terms of the leaders. Alcon is up by 6-7% in the eye care space. It is SSE that really stands out. Scottish and Southern up by over 10%. So this utility this morning is putting out a $2 billion investment program. Remember that the bottleneck in terms of the AI story, the bottleneck in terms of economic growth, you could argue, is getting electrons from A to B to C. And this is basically what they're going to try and solve. You've also got the renewable space that you need to fold into all of this as well. Grid connection, grids are really important. That stock is responding positively. SAP is up by 1% today, so the tech space is actually getting a little bit of a lift as well. Where are the laggards? It's in some of the more defensive names, actually. That is where we're seeing some of the disappointment today. Unilever is down. Shell is also giving back some ground. We're going to talk about what is happening in the energy space in just a moment with Amrita said. And Swiss Life is down by 2.34%. But there's some interesting trades out there this morning, but quite a lot of dispersion in terms of what we are seeing. So that's a kind of interesting narrative as we come towards the end of this reporting season. Anna, what else do we need to know?
Yeah, let's get an update then, Guy, on some of the other political stories and other news flow that we need to keep on our radar. Allies of Keir Starmer have sought to ward off any leadership challenge by arguing that an attempt to oust the UK Prime Minister would risk a market shock and undermine the government's finances. Centrist Cabinet member Wes Streeting said this morning that there was no leadership bid from him and that he supports the Prime Minister. Starmer is likely to address the issue at the weekly question session in the House of Commons today, that is, Prime Minister's questions. Debates over France's 2026 budget are dragging on in Parliament. Lawmakers will spend the day discussing the Social Security financing bill with a vote on suspending the 2023 pension reform by the end of the session. The vote is seen as decisive for the survival of Sébastien Lecornu's government. And Bloomberg has learned that President Trump is to host financial industry executives for dinner later today at the White House. It's the latest effort by the administration to get the country's business elite behind the president's policies. We're told JP Morgan's Jamie Dimon, David Solomon from Goldman Sachs and BlackRock's Larry Fink are among the invitees. Kriti.
Lots to go on when it comes to what we might actually hear from that dinner. I'm really curious. We were kind of debating this around the table earlier today. We were talking about deregulation. We were talking about sanctions relief, maybe even just his thoughts on tariffs, et cetera. Does the oil market show up in that?
I don't know. Maybe it's a fact. It's going to be interesting. So one of the things that I think that the Republicans, Trump will take away from the recent kind of political story is that they need to get back on the front foot, and lower gas prices in America could be certainly part of the political narrative. You get gas prices down, that's going to put more money into people's pockets. That gives them a better feeling about what is happening, particularly at the bottom end of the economic spectrum. So I just wonder whether gasoline prices could be a part of the story in terms of the politics.
I mean, affordability is the key message, and we've heard that time and time again this morning, but of course in the last couple of months as well. I think it's really crucial as well is that does any of this matter? Does any of the tariff stories, any of the trade matter? At the end of the day, this market, as consensus suggests, is oversupplied. Let's get a bit of a market perspective from here. Amrita Sen, founder and director of market intelligence over Energy Aspects, joins the program. Amrita, pleasure to have you. Thank you so much for joining us this morning. The consensus is that this is a market that's oversupplied. We talk about Russian infrastructure attacks, tariffs, a decline in growth, gas prices, as Guy just mentioned, among a series of other factors, and this market doesn't move. I want to start off by just asking, what's the range for oil? What's the floor? What's the ceiling?
Yeah, thanks for having me. I think oil's been really stark. I mean, you can see that over the last few months, really, not just the last few weeks. It's weathered a huge number of headlines on kind of U.S. sanctions on Russia, but at the same time, it hasn't collapsed either, despite all the kind of narrative around a really big supply surplus coming up in, not just in Q4, but really coming up in 2026. Given that kind of really varied risks on both sides, because you have the very bullish possibility of quite a bit of Russian supplies getting lost versus the bearish risk that, we are in an oversupplied market or getting into an even oversupplied market with the OPEC plus unwinds still ongoing. I think that's why prices will remain stuck as well around this kind of $64, $65 mark for Brent, and a couple of dollars really. I'd say 60 to 65 is your newish range, unless the market kind of sees or starts to see more material disruption to Russian supplies.
Rita, let me ask you about some of the news flow we've had surrounding oil. There's been lots of bits and pieces to keep an eye on, even if some of the underlying US government data has been absent, of course. We've got an IEA report today. They're reinstating one of the scenarios that they're considering, and that is that oil demand continues to climb out to 2050. What's your thinking about when oil demand peaks? Because IEA has this scenario, but it also has another where it peaks around 2030. BP has been playing with its estimates, though, of when we get this peak, also suggesting it could be later. What's your thinking?
Well, look, great question, because I know we all tend to focus so much on the short term, but some of these longer term trends are changing, and I think it's kind of becoming a lot more aligned with what we've been saying. As an industry, if I may say so, we are really bad at calling oil demand. We continue to call for peak oil demand and then just push it further and further back every year. And I think our view has always been that, yes, even if total liquids demand kind of peaks, say, late 2030s, even early 2040s, the reality is it's not going to collapse. Even by 2050, we have oil demand at around 100 million barrels per day. And I think that's the crucial thing. A lot of the scenarios with kind of some of the names you've mentioned had oil demand falling to 60, 70 million barrels per day. Even at the peak of COVID, we consumed over 80 million barrels per day and the whole world was shut in. So to just assume that we would go down to 60 or 70 million barrels per day by 2050, I think that caused a lot of damage to the industry with the lack of investment. And I think we're going to see the effects of that in the coming years. And I do think we'll see higher prices as a result of that. But it's really good to see a lot of these agencies now coming out, like the IEA's latest report just abandons all different scenarios, and it's got that one scenario that says that on current policies, oil demand continues to grow. That's a significant shift.
Yeah, we'll continue to get the details on that then. Let me go back to the short-term picture, Amrita, having put some focus on the longer term, and go back to what Kriti was talking about this balance between the oversupply narrative and the sanctions narrative. And on sanctions, I'm really interested that there's been a sort of a scramble to deal with Lukoil's international assets. You know, who's going to own them? What will happen to prices if the West is not allowed to deal with Lukoil in any form? I mean, this is a business that has a footprint in the US, Italy, Netherlands, Bulgaria, Romania, Iraq. I mean, maybe not a big footprint, but it does have a global impact. Is it inevitable that if the West can't trade with Lukoil, that prices should feel some upward push?
I mean, look, this is unprecedented, right, in terms of both, not just Lukoil, Rosneft as well. We are talking about, at least on our calculations, at least 1.4 or around 1.5 million barrels per day of Russian crude exports that are at risk of being backed out, because we have seen, I was in India myself a couple of weeks ago, the refiners we've spoken with, they've kind of said, yeah, certain ones are completely backing out, others are reducing. China, we've seen the state-owned companies have also stopped purchasing from these companies. We already had Surgutneftegas and Gazprom Neft under sanctions from earlier in the year. So you only have 3.1 million barrels per day of Russian production currently that is not sanctioned. And then, of course, you've, like you mentioned, in terms of Lukoil's international assets, we saw what happened with Gunvor and then the Treasury kind of statement around that. There are a couple of other buyers who are looking into it, but it is going to be extremely difficult to kind of get to a scenario where all flows continue uninterrupted. Like, of course, the total volume lost could be a lot more. We are not assuming the full 2.6 or 3 million barrels per day of Lukoil plus Rosneft volumes getting out of the market, but at least 1.5 can be at risk in the short term.
Amrita, good morning. It's Guy. If you were Donald Trump and you wanted to get WTI from 60 to 50, how would you do it?
Well, it was heading there, right, Guy? I mean, we had even Brent was sub 60, WTI was closing in on 55. And that was, even on our kind of price forecast, that is the kind of path of least resistance for next year, Q1, early Q2, given the oversupply that we're looking at, the Chinese SPR bid, which has really kept the market fairly tight this year. That should also seize up a little bit in the short term because the next mandate is in March. So all of those factors were actually driving prices lower into the kind of 50s, which is probably where, you know, some U.S. officials, or at least Trump, wants prices to be. But these Russia sanctions are material. I know they've kind of named companies instead of saying blanket Russian oil, but we, having just come back from the East, I think the market might be underestimating that.
Okay, so do you think 60 is a more realistic prospect for next year than 50?
I think if these Russian sanctions are enforced, and that's the million-dollar question, right? Because we've seen this before. The U.S. announces a bunch of stuff, and then they don't follow through with it. So short term, absolutely, like I was saying, 60 to 65. If they do enforce it, I think prices go higher. But even otherwise, I'd say with these Russia sanctions, even in like a moderate form, 60 is probably a better flow.
Well, speaking of flows from around the world and, of course, the Russia equation as well, Amrita, a final question to you on Venezuela. There's a lot of questions here about what Donald Trump's strategy is towards Latin America broadly, but specifically towards Venezuela and the oil supply and the partnerships that happen between Venezuela and Russia. How seriously is that threat being taken in the people you speak to?
Not much, in the sense that I think it's gone the other way, where a lot of people are asking us, oh, we'll have a lot of Venezuelan oil following regime change. Firstly, I don't think the U.S. is kind of going in directly. Yes, they probably do want some regime change, but they're not kind of, putting boots on the ground. More importantly, the Venezuelan upstream industry is completely damaged. It's going to take hundreds of billions of dollars and years to resurrect that. And the debt that PDVSA has is the biggest crippling factor. So we're not looking into swathes of Venezuelan oil coming to the market in the next few years. So I think this is a long-term story, if it were to even happen.
Amrita, great to catch up. Thank you very much indeed for your views. Amrita Sen, founder and director of Market Intelligence, joining us from Energy Aspects. Coming up, the big story, the US House of Representatives returning to work today. A vote on the bill to end the longest ever US shutdown on the docket. We'll talk about that next. This is Bloomberg.
November 26th, Chancellor of the Exchequer Rachel Reeves delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
Welcome back to the opening trade. 46 minutes into our European session, and it is looking increasingly positive. We've had earnings stories to deal with. US futures also increasingly positive. Nasdaq futures up by 0.6% right now. Let us turn to matters European, though, and to the French budget story, which continues to rumble on. The French Parliament is scheduled to vote today on suspending the 2023 pension reform as part of the Social Security financing bill. The vote is considered crucial for the stability and survival of Sébastien Lecornu's government. Let's talk to Bloomberg's Caroline Conan, of course, who is in Paris for us. What's being debated then today? Help us look ahead, Caroline, and why does it matter to the overall budget story?
You know, the suspension of the pension reform that brought the retirement age in France from 62 to 64 years old back in 2023, well, that suspension was a key request from the socialists last month in order to avoid another vote of no confidence against the current Prime Minister, Sébastien Lecornu. So unless there's a big surprise, this reform should be suspended today until 2027, which is the next presidential elections. Sébastien Lecornu has claimed he had no choice in order to keep the socialists on board. So this has been included in the social security part of the budget, which is being debated this afternoon. Remember that same social security part of the budget that made the government of Michel Barnier collapse pretty much 1 year ago. Of course, this comes at a cost. This will cost about 400 million euros in the next budget, 1.8 billion euros the following year, and as much as 15 billion euros by 2030. There was, though, one first ray of hope with a vote on Saturday on the revenue part of the social security budget, which passed in a very tight vote, 176 against 161. That made one MP from Macron's camp say that we may see the emergence of a bloc of reason within the National Assembly.
Reason in the National Assembly. Taxes in the National Assembly as well. More taxes.
Yeah. That's right. We're still really far away from a final vote on an overall budget in France. But in the first discussions, the amendments created as much as 40 billion euros of extra new taxes compared to 15 billion euros in the initial copy of the French government of Sébastien Lecornu. These new taxes are mainly targeting wealthy individuals, capital, and big companies. The so-called Zuckman tax was rejected. However, we are seeing the return of the exit tax for those who decide to leave France, for example. There's also a new tax on so-called unproductive wealth, which is luxury yachts, private jets, or what they call non-productive real estate. On capital, Parliament approved a tax on super dividends and increased the tax rate on share buybacks from 8 to 33% in order to bring in 8 billion euros. And of course, remember this exceptional tax on big companies that was supposed to last only 1 year in 2025. Of course, this has been expanded for another year in order to bring in another 6 billion euros. So a lot of new taxes there. Of course, this tax is not approved at the moment. It will then go to the Senate by tonight, by midnight. And of course, it could be amended by the Senate, which has a center-right majority.
Well, looking forward to seeing how this all plays out. Yet another twist and turn in the French political saga. Caroline Conan, of course, joining us from our Paris bureau. We thank you so much. It's a similar story in Washington, where the U.S. House of Representatives will be back at work today for the first time in nearly 8 weeks to vote on a bill that would end the longest government shutdown in American history. For now, we're joined by Bloomberg Managing Editor for the U.S. Economy and Government, Mario Parker, hot-footed it over here from Washington to join us this morning. Just walk me through the likelihood that come Friday, the government's open.
Well, at the risk of handicapping this Congress and this chaotic political landscape in the U.S., the likelihood is quite high at this point. There's a lot of optimism that the shutdown is going to finally be ending. The fact that Congress, that the House of Representatives is in and of itself coming back after almost 8 weeks of quote-unquote vacation is a positive sign.
In terms of what happens when it reopens, just walk us through the kind of, how do you reopen a government? Talk me through the kind of what people are talking about in D.C., what happens first, what kind of clues are we going to get about when the data arrives? Kind of just give us a sense of the next few days if it happens.
Yes, well, one of the things, the main thing that people in D.C. are talking about right now are just the federal workers getting back to work. Yep. One of the pain points that we saw with this, and the reason that Democrats essentially caved, even as they had a winning hand, was these images of bread lines with federal workers, the backups with airlines, the hit to the hospitality and airline industry as well. So the main question as we approach Thanksgiving is how quickly can airlines get back to normal, first of all. The data, the resumption of the data, the economic data that our traders, our readers depend on so heavily as well. It's unclear right now how quickly that will resume, but that's a main question as well. And then again, as I mentioned, just the fact of federal workers getting back to work. Do they report back on Monday, next week? How does that look?
Mario, does the way that this was handled and the way it eventually ends, does it tell us anything about how close we're getting to the midterms, about how attention is increasingly focused on the midterms?
Yes, absolutely. I think one of the things, if there's anything, a moral victory that the Democrats scored, again, last week they had a very good tangible victory in some of the key elections. This week, even as there's some consternation among parts of the base, the moral victory is that you've got the argument settled on affordability. You've got the White House a little bit on its back foot with the economy as well, and then you've made yourself as the party of taking care of health care costs.
Mario, thank you very much. Thanks for joining us. Good to see you in London.
Thank you.
What a treat, helping us get to grips with the shutdown story right here in London. Let's bring in Bloomberg's Valerie Titel, who's been watching this, of course, from a market's perspective. Val, developments in Washington, we haven't had a lot of data, so maybe we're a little in the dark about the data and therefore the Fed's path from here. So the shutdown really matters from a data perspective.
Yeah, no, it does. It does. I think the market is really keen to hear from the Bureau of Labor Statistics as soon as they're back in the office, the kind of schedule that they want to put together in terms of data releases. We're getting this backlog, this fog lifted in order for the Fed to have a better decision-making track for that December meeting. We have 4 weeks today in between now and that December 10th decision from the Federal Reserve. And the question is whether that backlog will be cleared in a meaningful way or will they'll still be struggling to get the data releases out the door. The other thing that is very topical with this is just the resumption of liquidity. We know that the equity market really struggled last week. We did see some front-end basis widening out, and a lot of that can be tagged to the fact that there's a liquidity problem right now because the Treasury isn't necessarily paying out these payments. There has been a cash balance rise in the Treasury General Account, the TGA. A rapid unwind of that could be something that could help the equity market, help the price of gold, help these front-end interest rates that businesses rely on for day-to-day funding come back to more normal levels, and that'll be something that would probably risk positive moving forward.
Do you think it'll come up at the dinner with Jamie Dimon and his Wall Street peers?
So this is a really interesting timing, I think, for the White House to invite most of the major executives. JP Morgan, BlackRock, Morgan Stanley, all the CEOs will be convening for a dinner with President Trump. Just what will he be trying to ask them? One thing on my mind is whether there will be some more political pressure on the Federal Reserve coming out of this dinner. Will he want to get Wall Street on his side in terms of calling for more reductions in interest rates that Jerome Powell seemed really hesitant to give the market guidance for at the decision
Do you think they would bite on that?
week?
Do you think they would take the bait on that? Jamie Dimon's been pretty clear on his concerns. So is David Solomon. He's talking about concerns around what is happening in terms of the debt track. There's lots of things going on here. Do you think is putting pressure on the Fed via these guys? Are they going to be the intermediary?
Well, in some way, you can say that Jamie Dimon is more powerful than Jerome Powell in his position at the helm of the world's biggest bank. But the other thing that Trump could possibly do is really try to push them to help this debt financing of the AI boom. We know that that's something that moving forward, Trump has been very successful at getting these AI pledges. He invited the tech leaders for dinner back in September.
But now you got to pay for it.
But now it's step 2. It's the debt financing. It's how are these companies going to handle this debt build out that, as we heard from tech executives in the last 24 hours, is still going really strong.
I mean, private credit seems to have stepped up to fund it, so maybe. But I guess there's still something for Wall Street to do for these particular names on Wall Street.
But Trump's biggest fear must be that actually the politics is moving against it. So you talked about the midterms. The midterms are a year away now. How does he use these guys to help him politically? How do you put money back in people's pockets? How do you convince people that the cost of living crisis is not real? Is this the right...
That's what Trump's asking the execs. I imagine the execs are also asking Trump about some of the antitrust pieces and the regulation because all their IB revenues are coming from the FTC basically not being on their back.
Yeah, so perhaps, the Wall Street executives will be asking the Trump administration to move a lot more quickly when it comes to deregulation that they want to see in the banking sector. There's a lot of things that are still overhanging some of these regulators that the Wall Street executives want to see done quickly, and that obviously will help them boost the bottom line.
Shutdown would have delayed a lot of this stuff as well, especially the boom in M&A that some of them had been looking ahead to. That would have been delayed.
Lots to discuss. Valerie Teitel will be back with the full briefing of how that dinner went.
I wonder what they're having to eat.
That's what I was going to say. Is it like gold-tipped
Who's going to be sitting on the left and who's going to be sitting on the right?
That's all that matters. That does it for the opening trade. The pulse is up next. These markets are in the green. Lots of interesting conversations. Don't go anywhere. This is Bloomberg.